In order to fully assess the performance of a business, and in particular the section in the balance sheet, we need to look at the working capital. So its new name will be called net current assets, but because many of you got confused between net and non-current assets, we'll call it its traditional name of working capital. So you need to refer to the section current assets and current liabilities. So this is really going to measure the ability of the business to pay off short-term debt. Couple of definitions to get you started. So how easy is it to convert an asset into cash? So if you look at your current assets, the top item will be inventory or stock. So if you think about it, you could, if you wanted to, have a flash sale. Many people would buy it. You would need to question whether or not they would buy in cash or if they would buy in credit, and so determining how liquid that asset is. Similarly, when you move on to receivables, remember there are customers who we have sold to on credit in the past and are awaiting payment. And as we remembered on Friday, we could consider using a debt factoring service to turn it into a more liquid item. So how quickly can you convert these items? When we look at the cash cycle then, we need to consider our starting place. We'll have to have some cash to begin with in order to purchase our raw materials. If we're really lucky and we've built up a bit of a reputation, we might find that we can have 28 or 30 days credit terms, and so there might be a delay here. When we move on, now that we've purchased our raw materials, we're obviously going to have to transfer it or transform it into a product. So if you were a production business, this could have some delay. You're going to have to pay for wages, you're going to have to pay all of your utility bills, you'll have rent to pay here. So there could be additional costs here. And remember the production, so let's say for instance, I used the example once before of producing whiskey, so we'll have a 10, 15, 25 year delay, so you need to consider how you would generate cash within that time. Once we have a finished product, so if you were a retail shop and you'd purchased immediately, you could find that the transformation is actually 0 time, the time that it takes you to put it on your shelf. Whichever is the occasion, we're going to have to spend some money on storage. So you might operate a just-in-time purchasing system where the money is held in your bank and you only just go to the supplier and purchase at that time. So this could have an impact on your business. Then hopefully we will sell the product to our customers. Obviously, depending on the industry that you belong in, depends on whether or not you would get immediate payment or cash payment. And finally, once we receive the cash, then you would be able to repeat the cycle. It's important that you consider this will be different for every industry, and so it's nice to be able to look at the case study, read between the lines, and really think about the need for holding appropriate cash so that you can continue trading on a short-term basis. So what other clues can we look for to determine if the working capital is at a sufficient level? So we could look at the time taken to sell inventories. So if you look at the nature of your product, sometimes you need to entice your customer in. So if you look at retail and you look at clothing, you need to have products that you can display in your shop to entice your customer. And so that will obviously take time for that to follow through. Could look at the durability of our product. If you're a perishable item, so your yogurts, your dairy products, Obviously, you can only hold a limited number of those. But look at the efficiency of a supplier. So, can you ask your supplier for short notice deliveries, or do you have to have a lead time that's quite considerable? So, the time that it takes you to tell your supplier you would like some stocks to receive it into your store. If you think about customer expectations, so for many, if you were to buy a car, you would expect that you can go to the showroom, you can put in all of the specifications, and 8 or 10 weeks later, you could have your car. Others are not able to wait so long, and so they may only have a limited choice, go to the showroom. So you've got to look at, is it a product that you're willing to wait for, or is it not? And then obviously we need to look at our competition. If your competition are holding high levels of inventory, you need to perhaps do the same in order to have the same competitive edge. Following on from that, we can look at the opposite side and we can look at our customers. So if you think about the nature of the market, so I wouldn't expect to go into Asda and do my shopping and then say, oh, I'm going to have 28 or 30 days to pay for my shopping. So some markets, they'll expect customers to pay straight away, and other markets, you might need to follow what other competitors are doing. If you look at the type of the product then, I could go and I could buy a wash machine or an electrical item, and there are certain electrical items that I might get 1 year free credit or something like that. And then you can look at the bargaining power. So let's say, for instance, Tesco's are quite notable for saying to their customers, their suppliers, I'm sorry, but we expect to pay after 60 days. And because the supplier has only a small bargaining power, they can't really stand up for them. They've got to take the terms on offer. On the flip side of that, if you are a business and you're desperate for the work, you might be able to say that you have to pay instantaneously. And our last item is the credit period offered by suppliers. Obviously, when you start up your business, you won't have a reputation, and it's likely that you'll have to pay your first or second order cash up front, and only once you build up a reputation, you may be offered a credit facility. We also need to consider what causes you to have working capital difficulties. So what means that you're short on liquid cash and may have problems meeting your day-to-day bills. So you might find that because you haven't got a centralised ordering process, or maybe you've delegated to someone who doesn't have experience, you might find that you have vast amounts of inventory. Remember that it's not just the purchase price, it would be the cost of keeping and the stock. However, you've got to travel a fine line, and you need to consider, can your customers wait? What do you need in order to meet customer expectations? You could have poor control of receivables. So remember, there are customers we've sold to and given them a credit facility. So it's important that a business regularly keeps on top of this and looks at, how do you chase up people who don't pay? Similarly, we could look at poor control of the payables. So there are suppliers. So if our suppliers have given us 28 days to pay, I think it's ineffective for our business to pay before the 28 days, because there's the opportunity cost of what could we have done with that cash, which might have allowed us to trade for longer. Of course, we could have simple cash flow problems, and so you need to consider, have you taken appropriate action? Do you look at your payments? Do you have excessive payments? And could those be fixed with a short-term or long-term cash solution? It could be poor internal planning and coordination. So let's say, for instance, it's important that our internal departments, our functional areas, work well in meeting the deadlines that we give to our receivables and we receive from our payables. Finally, there could be external factors. So let's say, for instance, consumer tastes might change, and so you could be left with an awful lot of stock. How do you solve these problems? We could look at our inventory control. So as a business has more trading experience, they'll find the appropriate level for them. So you've got to look at, should we have low levels or high levels of stock? Customer expectations are important here. What's the potential that we could have just-in-time deliveries? Will it be excessive costs associated to that, or could the costs be lower? Then we could look at our receivables control. So how do we treat our customers? So it's important that we have the functional areas that are going to invoice those promptly, chase up our late payers. Perhaps one way that we could look at it is we could obtain a credit rating. So this idea that they've got to be seen to prove that they are good for the cash in the first few orders, and then when we look at their credit history, so obviously there's a payment involved in obtaining a credit rating, but that could offset a receivable, a customer who doesn't pay at that time. We need to ensure that we offer a quality service, because that usually leads to a satisfied customer who's happy to pay and maybe give us some repeat business in the future. We've got to look at, is offering credit cost effective? So how much administrative or other costs do we have to pay in this functional area? And finally, we could look into whether it would be accessible to use a factoring service. Remember, you wouldn't get 100% of the money owed. Mostly you would get 80%, and we need to consider whether or not that would be worth it.